Hello everyone, it's Dr. Drusselback. Chapter 3 on the Accounting Information System is probably the most important chapter of all of the 11 chapters we're covering, because if you don't get this chapter down, the future chapters you'll never get, because they're all built around this chapter. So please spend a lot of time trying to understand what's going on in this chapter. So in chapter 3, we're going to talk about four primary things. One is, what is the accounting information system? That's going to be our first thing we do. The second thing we do is, what do we mean by the account? And then really important is this third phase, which is, what are the steps in the recording process? How do we take a transaction and record it? Keep a record of things that the company does. And finally, the trial balance. So what do we mean by the accounting information system? It's the system of collecting, processing transaction data, and communicating financial information to decision makers. The decision maker could be someone within the company, like a manager. It could be somebody outside of the company, like an investor or a bank making a loan to our company. So we're going to collect financial information. Financial information would include things like, how much sales did the company have? What kind of purchases did they make? How about the bills that they've paid, the money that they've borrowed? All those things are financial information. So we're going to, then the accounting system, we're going to collect all of that information, we're going to process it, and then we're going to communicate it. We're going to tell others about it. And most businesses use a computerized system, or EDP for electronic data processing. You have even smaller companies use accounting software like QuickBooks and such. So what is it that we're going to collect and record, process, and communicate? Primarily, it's transactions. Transactions are the economic events that require recording in the financial statements. So if you borrow money from a bank, that's a transaction because it's an event that requires recording. If you pay the rent, that's a transaction. If you sell a product, that's a transaction. But not all activities represent transactions. So for example, if you hire a new employee, that's not considered something you need to record in the accounting system. So which ones do require recording? Well, this second bullet tells you assets, liabilities, or stockholders' equity items that change as a result of the economic event. So if it's going to be recorded, it has to have changed one of those items. And each transaction has a dual effect on the accounting equation, and they call that double entry accounting. Double entry because it has a dual effect. So the question is, which transactions are recorded, which transactions are not recorded? And here's our criterion in the middle here. Is the financial position, that is the assets, liabilities, or stockholders' equity of the company, changed as a result of the event? If it's changed, then you have to record it. If it's not, you don't. So the first event up here is to purchase a computer. Does that change the financial position? Yes, it does. It changes it because now you have a computer where before you didn't. So your assets changed. The second one, discuss a guided trip options with potential customer. Let's say that you're a travel agency and someone comes into your travel agency and says, well, I want to talk about his guided trip. I want to go, to the Smoky Mountains and with the guided trip. Does that change the financial position? The discussion of it doesn't. So the answer is no. Now, if they would go ahead and purchase a trip, that would be different. That would be a transaction. The third one is to pay the rent. Does that change the financial position? Yes, you have to pay cash for that. So that's going to change your financial position. You have less cash now. So in analyzing transactions, which is the process of identifying specific specific effects of the economic events in the accounting equation. Remember that the basic accounting equation, we learned that before, is assets equal liabilities plus stockholders' equity. Think of it this way: what you own, how did you buy what you own? You either borrowed the money, which is a liability, or the stockholders put the money in. So what you own is on the left side. How you financed it is on the right side of the equation. Okay, so let's analyze transaction. We're going to take that accounting equation, which is on the first line here, assets equals liabilities plus stockholders' equity, and we're going to expand it. Because stockholders' equity we can expand, we know that there are two accounts, so we're going to expand our stockholders' equity now. We're going to expand it to common stock and retained earnings. And and then we're going to add those two together to get stockholders' equity. However, we can also break down retained earnings into three categories. Retained earnings, now remember what retained earnings are. Those are the profits of the company that are kept in the company and not paid out. So the profits of the company are revenues minus expenses. Revenues minus expenses. And if you pay out, which remember the difference between revenues and expenses, that's your profit or your net income. Now, when you pay out those profits to the stockholders, to the shareholders, those are called dividends. So we subtract the dividends because we're paying out those profits. So now we have assets equals liabilities plus common stock plus revenues minus expenses and then minus dividends. That's the expanded equation. So you can see the expanded equation goes down like this. Okay. Now let's take that expanded equation and we're going to add the individual accounts under each of those categories. For example, assets, we have different categories, different types or accounts within each category. We have cash, we have supplies, prepaid insurance, equipment, land, all kinds of different assets. And then notes, liabilities, different accounts. We have notes payable, accounts payable, and unearned service revenue, among others. And then stockholders' equity. Well, this is the breakdown we just talked about in the previous slide. Common stock plus revenues minus expenses minus dividends. So we're going to look at an individual transaction and see how it affects each one of these accounts. So let's look back up here at event number 1. On October 1st, cash of $10,000 is invested in Sierra Corporation by the investors in exchange for $10,000 of common stock. So you ask, which two accounts? Remember the dual effect of each transaction. At least two accounts are affected for each transaction. So we know from this event cash is affected and common stock is affected. So what does this look like? Cash went up by 10,000, so that's why we have a plus here, and common stock went up by 10,000. And the accounting equation still holds because now assets, which is 10,000, is going to equal liabilities, which is zero, we don't have any yet, plus the 10,000 is stockholders' equity. Let's go to a different event. On October 1st, Sierra borrowed $5,000 from Castle Bank by signing a 3-month 12% $5,000 note payable. So what accounts are impacted? Well, borrowing money, well, that's cash that you're getting from the bank, but when you borrow the money, you have to pay it back, so that's a liability, notes payable, both of which go up. So my cash goes up by 5,000, which is the borrowing the cash goes up, and I owe 5,000 more, so what I owe increases. A lot of people think, well, wouldn't that be notes payable going down because I owe that money? No, it's increasing what I owe. It's an increase of what I owe. The next transaction, October 2nd, Sierra purchased equipment by paying $5,000 cash to Superior Equipment Sales. Okay, so the purchased equipment, so you know we have equipment that's going to increase, and we have cash, but we paid cash, so cash is going to decrease. So we have a minus 5,000 cash and a plus 5,000 equipment. Now notice that means that assets now are going to be zero, right? Because you've got a minus and a plus. So the impact on assets is zero. And of course, we have no liabilities, no stockholders' equity. So the accounting equation works for every single transaction. Event number 4, October 2nd, Sierra received $12,000 cash advance from R. Knox, a client. Okay, so cash advance. So we have a client or a customer that pays us in advance of performing a service. We owe the service, so that's a liability. So we have the cash going up and we have the liability, unearned service revenue. Now this is a little tricky because a lot of people want to put that into the revenue account, but it's not revenue yet because it only becomes revenue once you've earned it, once you've provided the service. Remember, revenue is only something when you provide a service or deliver a product. We have not yet provided the service and we owe that customer that service. Event number 5, October 3rd, Sierra received $10,000 cash from Copa Company for guide services performed. All right, so we have, again, we are a travel agency, travel guide, and so we performed a service in this case. We got cash, so we got 10,000 cash, and we performed the service. So that means we're going to have cash going up and our revenue account going up. Revenue is when you provide a service. So we're going to have 10,000 increase in cash and a 10,000 increase in services. Remember, every transaction affects at least 2 accounts, and for every transaction, the accounting equation has to work. Event 6, October 3rd, Sierra Corporation paid its office rent for the month of October in cash, $900. So we paid cash, so cash going down. And what is office rent? Well, office rent is an expense of doing business. Remember, an expense is all those operating costs of running your business. So we have cash going down by 900 and we have an expense. Now an expense is subtracted from retained earnings in that it makes retained earnings go down. So we have a minus 900 on the left side and a minus 900 on the right side of the equation. Remember the equation we're talking about right here. The left side I'm talking about on this side, the right side over here of the equation. They always have to balance out. Event number 7, October 4th, Sierra paid $600 for a 1-year insurance policy that will expire on September 30th. So paid $600, so that's cash going down. What did they get? An insurance policy. Now, a lot of people would think, well, isn't that an expense? Insurance is an expense of running your business. It's true, but it's an expense as you are operating the business. In this case, you paid for that insurance in advance. So it's what we call a prepaid expense. So we have this account called prepaid insurance, and that's considered an asset. I know that's very confusing sometimes, but when you pay for something in advance, it is considered a prepaid expense, meaning that it's an asset. Why is it an asset? Because you get the benefit of that insurance. Now, once the year passes, you'll see that that prepaid insurance will become an expense. We're going to talk about that in the next chapter. But for now, we have the minus 600 cash going down, and then the plus 600 cash going up. And again, the left side balances out because minus 600 plus 600 is 0, and we have nothing on this side. Number 8, Sierra purchased an estimated 3 months of supplies on account from Aero Supply Company for $2,500. Now, some of you might think, shouldn't that be cash? But notice it says they bought that on account, which just means they didn't pay for it yet. They used equivalent to a credit card, in that you're saying to your supplier, I'll pay for it later. So you owe them that money later, and that's what we call accounts payable. So our accounts payable is going up. What else is going up? What did we buy? We bought supplies. And supplies are assets. Supplies is something that you have to use in the company. So we have supplies going up by $2,500, accounts payable going up by $2,500. So again, both sides of the equation balance out, plus 25 plus 25. On October 9th, Sierra hired 4 new employees to begin work on October 15th. Well, this is a little bit of a tricky one, because remember that a transaction has to have an impact on your financial position, which means it has to affect your assets, liabilities, or your stockholders' equity. Just hiring someone does not have an impact on any of those. So this transaction, this is not considered a transaction. This event does not get recorded in the books because only accounting transactions are recorded. Event 10, October 20th, Sierra paid a $500 dividend. All right, they paid. And you see this paid, that means cash going out. And a dividend is a distribution or a payment to your stockholders. And we have a separate account specifically for that. So we're going to have our cash going out, and we have over here, and we have our dividends going out. And so again, transactions, a minus 500 on this side, minus 500 on this side, they balance out. Finally, event 11, employees have worked 2 weeks, earning $4,000 in salaries, were paid on October 26th. Okay, so we're paid. You see that word paid, that means cash is going out. And then the other question, what are salaries? Well, salaries are expenses you have to pay your employees to operate the business. So expenses are costs of doing business. So we had cash going out, and we had our expenses. Now those are all the transactions for the month. So now all you do is add everything up. So the very last line is to add up all of these transactions. Just add them down, and that's going to come down to your total. Then remember the accounting equation here. So the equation means that the left side of the equation has to balance the right side. So if I add up everything on the left side of the equation, everything over here, that gives me 23,300. Then add up everything on the right side of the equation, that also is 23,300. And so it balances out. And so this is a good check to make sure you did everything correctly. Let's talk about the account. All of those items that we had on the previous slide, where you had the cash and you had supplies and your accounts payable, those are all considered an account. An account is just a place to record transactions of a similar nature. So everything that affects cash, we can put it in the same place. And so it is a record of increases and decreases in a specific asset, liability, or equity, revenue, or expense account. Now, these sometimes are called T accounts because you'll see the way they're set up, they kind of look like a T. See how the accounts look like a T? And so that's why they sometimes called T accounts. Over here on the left side of the account, so you see you have a left side here and you have a right side over here. And instead of calling the accounts left and right, way back 550 years ago when they developed this system, they used, instead of left and right, they used the term debit and credit. But all that it means, the debit just means left and the credit means right. So this side, the left side of the account, means the debit side, which is abbreviated DR. That's the Latin for it. And then the credit side is the right side, CR. It doesn't mean increase, decrease, etc. It just means left and right. So you could simply say left and right, but in accounting we say debit and credit. It's very important that you get this down, that the definitions of a debit just means the left side of the account. The definition of a credit just means the right side of the account. So really make sure you remember that. I talked earlier about this idea of the dual effect. Every account, every transaction must affect at least two, so two or more accounts, to keep that basic accounting equation in balance. And we call that the double entry system. So how that works is the recording done by debiting at least one account and crediting some other account. That's how you get the balance to work. So therefore, debits have to equal credits, and if that's true, then the accounting equation, assets equal liabilities plus stockholders' equity, will remain in balance. It's a pretty cool system. It takes a little bit of practice to get it down, but it's completely and internally consistent. Like I said, it's been around for almost 600 years. It was developed by a Franciscan monk, and it works. It works so well that it's still in use today. So what are the debit and credit rules, or the debit procedures? Well, if the debits are greater than the credits, the account will have a debit balance. So for example, if you have three transactions, transaction 1 was a debit, transaction 2 was a credit, and transaction 3 was a debit, what's going to be the balance? Well, you have $18,000 of debits and a $3,000 of credit. So what does that leave you with? $15,000 on the debit side. So the balance in the account is just whichever side is greater. So 18,000 minus the 3,000 is 15,000, and you keep it on the side which is greater, which is the debit side. If credits are greater than debits, then we'll have a credit balance. So transaction 1 was a debit of 10,000. If transaction 2 is a credit of 3,000, transaction 3 was a credit of 8,000, then what do we have? We have credits of 11,000 and debits of 10,000. And what does that give us? A net credit balance. So it's kind of netting the two sides into one side. The side that's greater is where the balance is. So how does all this work? Let's talk about assets and liabilities. In assets, the normal balance is on the credit side. And again, this is normal. It's possible that it works the other way, but very unlikely. And the normal balance for liabilities is on the credit side, which means what? So for all this to work, we have to have it such that the left side of the for assets, increases are on the debit side and decreases are on the credit side. For the whole accounting equation works, if that's true, then a reverse has to be true for liabilities. So for liabilities, debits decrease liabilities and credits increase. Again, this is just to make sure that the asset and liability, the accounting equation still holds to be true. Now, if we break down stockholders' equity, what we have is the same thing as liabilities. Debits decrease liabilities and credits increase liabilities and stockholders' equity. And then we break out stockholders' equity. Remember, we break it into common stock, retained earnings, and dividends. So the only thing that is a little bit unusual is that notice dividends has the opposite effect here, that increases on the left side. Well, why is that true? Because remember in the accounting equation we said minus dividends, so we had to flip the signs on that side. So for revenues and expenses, again, revenues, remember we added to. Remember that? We added to the accounting equation. So they're going to act like liabilities do. So the increases go on the right and the decreases on the left. And the expenses, since we subtracted them from the accounting equation, we have to flip the signs, which means the left side is for increases and the right side, the credit side, is for decreases. Well, why does this work? Remember, we learned this in the last chapter, the relationship between the three statements: balance sheet, income statement, and retained earnings statement. The first thing you do, if you remember, you complete the income statement. We take a revenue, subtract out our expenses. That gives us net income. Net income is then added to our beginning retained earnings. And then we subtract out ending dividends to get an ending retained earnings, and that goes up onto the balance sheet as part of stockholders' equity. So they're all interconnected. So let's just summarize these normal and debit and credit rules. Remember, we have the accounting equation, so we're going to kind of draw a line in here. Assets, here's a quick way to remember these rules. Notice that assets and expenses kind of go in the same direction. That the left side, or the debit side, increases assets. Same thing is true with expenses. But notice on the other side of my little green line here that the opposite is true. Credits increase liabilities, stockholders' equity, and revenues. And then, of course, the opposite is true for decreases. For assets and expenses, credits decrease those accounts, but for liabilities, stockholders' equity, and revenues, debits decrease those accounts. So if you remember, just remember this: these two accounts, assets and expenses, are increased on the debit side, where all the others are increased on the credit side. And then the opposite is true for decreases. Why does this work? It works because of the accounting equation. Assets equals liabilities from stockholders' equity. So if you put something on the debit side of one side of the equation, to get everything to balance out, you had to put it on the credit side for the other side of the equation. And here's just another summary of the debit and credit rules. This is I like this one, it's all on one page. So assets are increased with debits, and so are expenses. And everything else causes the debits to decrease. Debits cause those other accounts to decrease, where I reverse it with credits. The credits decrease assets and expenses. So that's just one page that has everything summarized right there for you. Remember those rules. Print that page, commit it to memory. Do not forget it. You're going to need that going forward. All right, so the relationship among the assets, liabilities, and stockholders' equity, the accounts. Again, this is just summarizing everything. Remember that assets equals liabilities plus stockholders' equity, and then we can break stockholders' equity into common stock and retained earnings, and the retained earnings we break down to dividends and our net income, which is revenues minus expenses. And so you'll see that three of the accounts, assets, expenses, and dividends, all have debits to increase those, where everything else, all the other accounts, which are what? Let me get a different color here. We have liabilities increase with the credit, common stock increase with the credit, retained earnings increase with the credit, and revenues increase with the credit. All right, so assets, dividends, and expenses work one way, the other accounts work the other way, the opposite. Here's a review question. Debits do what? Well, if you think back to what we just did, debits increase assets and decrease liabilities. That's the only one that holds true. Accounts that normally have debit balances, well, I just said, remember there are three of them, and those are assets, dividend, and expenses. All of the others have a normal credit balance. Let's talk about how we record things. First thing we do is we analyze a transaction and we enter the transaction into a journal. A journal is just a chronological listing of transactions. And then step 3 is we transfer the journal information to what are called ledgers. And we'll take each one of those and see what we're talking about. But we start with what's called a source document. And a source document is like a sales slip, a check, a bill, a cash register tape that provide evidence of the transaction. It might be a sales invoice, whatever that document is. So what is the journal? It's where we originally record things. Kind of like thinking of a diary, right? What do you do in a diary? Every night you go in, enter what you did during the day. So that's the events you did in the day in chronological order. So that's what we do, transaction recorded chronologically. And where it contributes to the recording process, it discloses all of the effects of a transaction. It's in a chronological order, and it helps to prevent or locate errors because debits and credit amounts can easily be compared to make sure that they balance. So journalizing is the process of entering a transaction into the journal. Let's show you how it works. Here are 3 transactions related to Sierra Corporation. These are the same 3 we just went over earlier. And they want you to take each one of these transactions and journalize them, which just means record them in the journal. All right, let's do them one at a time. So remember this transaction we did before. Sierra issued issued common stock in exchange for 10,000 cash. We showed you this earlier. That affects cash and common stock, both of which go up. Now you remember the debit and credit rules. Debits increase cash, so we know that to increase cash we're going to need a debit there. But for common stock, it is a stockholders equity account, and we know that credits increase equity accounts. So we're going to record the journal, we're going to debit to increase the cash, and we're going to credit to increase the common stock. Notice with credits we normally indent a little bit just as a super reminder that we put it on the right side. So debits are the left side of the account, so that's why we put them over here on the left side of the journal, and credits are on the right side of the account, so we put them on the over here on the right side of the journal. So we do that for every transaction. Transaction number 2 is when they borrowed $5,000 by signing a note. And remember, we saw this earlier. Cash went up, accounts payable went up. Cash is what? Cash is an asset. How do we increase assets? By debits. And how do we increase liabilities? With a credit. So we have cash increased, or left side, debit side, 5,000. Notes payable increase, which is right side. And notice that the debits equal credits. For every transaction, debits have to equal credits. And then they purchased equipment for $5,000. Well, cash is an asset that decreases. How do we decrease assets? With the credit. Equipment is an asset that increases. How do we increase assets? With the debit. So I'm going to debit. We always list the debits first, the increases first, or the debits left side first, and that's going to be equipment. And then we credit cash for 5,000, and then again debits and credits balance. Pretty cool system, right? All right. So what we have done is we've recorded everything in the journal. That's called journalizing the transactions, and that's our first step. And then after that, we're going to post. This is called posting, is when we have the ledger accounts, which are those individual accounts. The ledgers are comprised of the entire groups of accounts maintained by the company. So remember all of those individual accounts like equipment, land, supplies, cash, all of those things that on that earlier page that we showed. And then all of our liability accounts, interest, wages, accounts payable, notes payable, all of our stockholders equity, revenue, of our revenues, our expenses, our dividends, etc. So each one of those has its own account. We showed you the T account earlier. Actually, it's called a ledger account or a ledger, and that's where we record the effects of each transaction on those individual accounts. So we have what's called a chart of accounts, which is a listing of all the accounts used by a company. And so every single account they'll list under the assets, whatever liabilities they have, etc. So those are called the chart of accounts for all of the accounts that they have. So we call this process posting. It's the process of transferring the journal entry to the ledger accounts. And remember, journalizing is what we call the recording in the journal. Posting is we call transferring the journal entries to these ledger accounts. So remember the journal entry. This is the journal entry we made earlier, and we're going to take that and we're going to transfer it into these ledger accounts. So for example, we issued stock, and we're going to take that 10,000 and record it in the journal. So in each transaction, we're going to record the date when it happened. We're going to explain what happened. We issued stock. We're going to record a reference here, and the reference meaning where it came from, and that reference is up here, which is journal J1 for journal page 1. And we're going to normally assign account number to each account. So we're just taking the debits from our general journal, transferring it down into the ledger account. So everything that affects cash will be shown in that account. Let's show you how that works. Oh, I'm sorry, and then we bring the balance over here too. Here's a review question. Posting does what? Posting transfers, this is just the definition, posting transfers journal entries to ledger accounts. Well, let's look at each one. A, posting normally occurs before journalizing. No, it's after. Posting transfers ledger information to the journal. No, it's the other way around. Journal information to the ledger. And C, posting is an optional step in reporting and recording process. No, it's required. So let's put it all together. This is the process that you follow for every event. Every time a company enters into any kind of transaction, this is what they do. Number one, they determine what type of account is involved. Number two, determine what items increased or decreased and by how much. And number three, translate the increases and decreases into debits and credits. So I'm going to take those 11 transactions that we saw earlier and redo them for the entire accounting process, recording process, excuse me. Event number one, same thing we did before. On October 1st, stockholders invest $10,000 cash into an outdoor guide service company to be known as Sierra Corporation. The basic analysis is the first thing you do, and that is decide what happened from that transaction. We know that the asset cash is increased by $10,000 and stockholders equity, and in this case specifically common stock, is increased by $10,000. Put that into the equation analysis format, and we know that cash has a plus 10,000 and common stock plus 10,000. And now let's translate in that to debits and credits. Debits increase assets, so we debit cash. Credits increase stockholders equity, so we know we credit common stock. And then take that and put it into journal entry format. Debit, remember, go on the left. We debit cash and we credit common stock, and then we take that and we take the journal entry and we post it. So the cash goes on the debit side, the common stock stays on the credit side. Repeat for every transaction. You get this down, you got it. This is really, really important to get this down. All right, repeat for event two. On October 1st, Sierra borrows cash, $5,000, sign in 3-month 12% $5,000 note payable, and the analysis is that asset cash is increased and the liability notes payable is increased. Put that into equation analysis. Cash increases 5,000, notes payable increases 5,000. Translate that debit credit analysis. Debits increase cash, credits increase liabilities, and then journalize that. Debit cash, credit notes payable, and then put that into the T accounts, and that's what it looks like. Repeat it for transaction 3. Use 5,000 cash to purchase equipment. As equipment is increased by 5,000, cash is decreased by 5,000. In the equation format, cash decrease, equipment increase. Debit credit format, remember debits increase assets and credits decrease assets. And then we post that to the respective accounts. Oops, sorry. Journalize first. Then I got to journalize first and then post to the respective accounts. Event 4, October 2nd, they received $1,200 cash advance from a client. And remember that what that is the cash is increased by $1,200. The liability unearned service revenue is increased by $1,200 because remember that the revenue has not yet been earned. So we have cash going up by $1,200, Unearned revenue $1,200. Debits increase cash, credits increase liabilities. We journalize that, debit cash, credit unearned service revenue, and then post those transactions. So we're going to debit cash and we're going to credit the unearned service revenue. Event 5, same thing. Receive $10,000 cash for guide services provided. And so what happens? Cash is increased by $10,000. Service revenue is increased by $10,000. In the equation analysis, plus $10,000 cash, plus $10,000 service revenue. Remember that debits increase assets, so we debit cash. Credits increase revenues, so we credit service revenue. So debit cash, credit service revenue, and then post those to the accounts. Are you starting to get the hang of it, I hope? Event number 6. I'll do one more and then we can see if you can talk your way through it. October 3rd, Sierra paid office rent for October in cash $900. Rent expenses increased because the payment pertains to the current month. Asset cash is decreased. So cash is decreased and rent expense. Debits increase expenses and credits decrease assets. Now a lot of people are going to get confused here because this says increased expenses, but up here we said a minus. Well, expenses are increasing. What's decreasing is stockholders' equity. See how this is under stockholders' equity? So stockholders' equity is going down, but expenses are increasing. So it looks like you're contradicting, but you're not. So your increase expense with a debit, decrease assets with a credit. So now I'm going to post those. So I'm going to take the $900 rent expense. It's a debit, and cash credit of $900. All right, event 7, October 4th, Sierra paid $600 for a 1-year insurance policy that expired on September 30th. Take a minute, read through this, see if it makes sense. If it doesn't make sense, this is when you need to send me an email and say, I don't understand event 7 or event 4, 2, 1, whatever it is. Okay, let's go on to the next one. Event 8, they purchased 3 months supplies on account for $2,500. We'll work this one together. Increase supplies by $2,500, which is an asset. Liability accounts payable. Remember, because on account means they didn't pay cash. So cash is not decreasing. What's happening is supplies are going up and accounts payable are going up because we owe the supplier. So what we owe them is going up. Well, how do we increase an asset? With a debit. How do we increase a liability? With a credit. So I'm going to debit supplies and credit accounts payable. Then I'm going to post those to their accounts. And that's how you would go through that transaction. Event 9. Remember, event 9 is when they hired the 4 employees. Hiring an employee is not an event that needs to be recorded because it's not a transaction. There's not a transaction. You haven't paid them yet, so therefore, and they haven't even done any work yet. So there's not an accounting transaction. Your financial position has not changed. Number 10, they paid $500 dividends to the stockholders, cash dividends. Dividends is increased by $500 and cash is decreased. We paid them. So cash and dividends. Again, It looks a little confusing because we say increase and then we subtract. It's increasing the dividends account, but dividends are part of stockholders' equity. So this transaction here is decreasing stockholders' equity, but you're actually increasing the dividends account because you're paying more dividends. So how do we increase dividends? That's with a debit. And how do we decrease an asset, cash, with the credit? So we debit dividends and we credit cash. So the dividends account is going to be recorded, posted, and the cash account is going to be posted. Last one, October 26th, Sierra paid employee salaries of $4,000 in cash. Remember, we hired the employees, but now we're paying them. So this is a transaction because we're actually changing our financial position. So what are we doing? Salaries are an expense. So an expense account is increased and an asset account, cash, is decreased. So cash is decreased and expenses, same thing here. Even though it says the expense account is increased, why are we having a negative there? Because the negative is the effect on stockholders' equity. But the account salaries and wages is actually increasing because we're paying more salaries and wages. So what do? Debits increase the expenses and credits decrease the assets. So we debit the expense account, salary and wages expense, and we credit cash for $4,000. Then we go and post that to their respective ledger accounts, and that's where we end up. So if we put all of these entries together, a journal shows all of the entries. So let's summarize the journalizing of all of those transactions that we talked about earlier. So they're just listed in chronological order. We put the date here. So notice we have the date over on the left, and it's chronological. And then we account titles. What are the names of the accounts? Are listed here. Sometimes, not always, we put in parentheses the explanation, what happened. It's a good idea to do that. And then we have the debit and credit column. So that's what the journal looks like. But remember, for every entry we make over here, we're going to have to post all of those things to the individual ledger accounts. So the journal is a chronological listing of all the transactions, and then the ledger is where we transfer all of those transactions to their actual accounts. So there's the second part of the journal. And then the posting. We take all of the transactions and post them to the accounts, and this is summarize everything we already showed. Then at the end, you're going to get the balance. So for cash, I'm going to add up all of the debits and then subtract out all of my credits, and that's going to leave me whatever side's greater. So my debit side's greater, I put the balance in there. So subtract all the credits from the debits, you'll get debits greater by 15.2, and we do that for every single account. So we're going to do that. Obviously, it's easier for service revenue. We only had one transaction. Cash tends to have the most transactions, but many of them only have a few transactions. So, but the point is, you want to list the balance and keep it on the proper debit or credit side. All right, so let's do it. Select a transaction from the Journal of Fatal Inc. during its first month of operations, presented below. Post these transactions to the T accounts. Well, basically what you do is just take each transaction. So there's the 30,000 debit to debit, and then we'll take the 30,000 credit, put it in our common stock account, take the accounts receivable debit and just transfer it over, just mechanically transfer it over, and then the revenue, going to mechanically transfer it down, credit to credit. So the posting part of it is very mechanical. It's just transferring one to the other. Let's put the cash in there. Cash, we had a debit, so we're going to put that cash debit into the debit over here, and the accounts receivable credit, I'm going to put it over here. The last step that we're talking about in chapter 3 is the trial balance. And that is just a list of the accounts and their balances at a given time, normally at the end of the month, a quarter, or year. And the accounts are listed in order in which they appear in the ledger. And look at this hint. Normally in the trial balance, they're listed in this order: assets, liabilities, stockholders' equity, revenues, and expenses. The purpose is to prove that debits and credits equal, that they balance. So they may uncover errors in journalizing and posting. If your debits and credits don't balance out in your journal entries, then they're not going to balance out in your trial balance. And it's very helpful when we prepare the financial statements, which we'll see in chapter 4. So here's our trial balance. If you go back a few slides, we took the ledger, whatever account balance we have in the ledger, just bring it over here. So you might remember cash had a debit balance in the T account, in the ledger account. All I do is transfer the balance or list the balance of each account and keep it on the correct side, either debit or credit side, and then add up everything, all of your debits, add up all of your credits, and they should equal. If they don't, you made an error. You either made an error in your journal entries when they didn't equal each other, or maybe you posted to the wrong side of the account, or you posted a wrong number. So the limitation: a trial balance may balance and still be incorrect. That's a problem. They could balance, that does not mean it's correct. When could it balance even if it's not correct? Transaction is not journalized, you just left something out. Or a correct journal is just not posted. You made the journal entry but you didn't post it. If you record something, if you post something twice, they'll still balance, they'll just have twice as much in there. Incorrect accounts are used for journalizing and posting. That's the biggest problem. If you put it in the wrong account, it's still going to balance out. And then offsetting errors are made in recording the amount of a transaction. You make an error twice. Let's do the review question. A trial balance will not balance if a $100 cash dividend is debited to dividends account for $1,000 and credited to cash for $100. So the debits and the credits, are not going to balance. So the trial balance won't balance. However, if the correct entry is posted twice, it will still balance. The purchase of supplies on account is debited to supplies and credited to cash instead of what? You should credit to accounts payable. It's still going to balance, but you have it in the wrong account, so it won't catch that. Lastly, a $450 payment on account is debited to accounts payable for $45 and credited to cash for $45. So you made the journal entry using the same numbers, but it's an incorrect number. It's still going to balance, but it's going to be wrong. Let's look at IFRS. Remember, IFRS are what the International Financial Reporting Standards. What does the international community do here? Transaction analysis is the same under IFRS and GAAP, US GAAP. However, different standards sometimes impact how they're recorded. European countries rely less on historical costs and more on fair value than US companies do. However, the double entry system is the basis of accounting system worldwide. Every country uses that. And finally, both the IASB, which is the International Accounting Standards Board, which prepares those international standards, and the FASB, which, remember, that's the US body, go beyond the basic definitions provided in this textbook for key elements of financial statements: assets, liabilities, equities, revenue, and expenses. In other words, there are lots of standards that are different we're not going to get into in this Principles of Accounting course. Which statement is correct regarding IFRS? IFRS uses the same process for recording transactions as does GAAP. A trial balance under IFRS is the same as GAAP. One difference between IFRS and GAAP is what? And that's just that IFRS tends to use more fair value measurements, which is what the accounts are worth, than GAAP does, which tends to use historical cost. So I know this was a long chapter, but this is a very, 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 very important chapter. So if you didn't understand it, go through it again, ask questions. Do not go on to the next chapter until you understand this one.